Welcome back to our weekly market recap. The world's most important energy choke point gets shut down. Oil spikes 70%. The WIX doubles. Headlines are screaming recession, stagflation, World War III. And what does the market do? Rallies. Not just stocks, Bitcoin, commodities, credit, broad-based across asset classes, across geographies. The S&P just hit a new all-time high. Nasdaq is on an 11-day win streak, and nobody believes it. It's hated. I think it's most hated rally of the last several years. Sentiment is in the gutter. Fund managers are underweight equities, and retail is sitting in money markets. And yet, price action is screaming risk on with breadth across multiple asset classes. So today we are going to show you the receipts, 22 assets, 5 buckets, 7 weeks of data, just data, no noise. And not just who won and who lost, but what the breadth of this rally tells us about where we are in the cycle. Quick disclaimer, we have a construction site here next to me, so I hope the audio quality will be okay. As always, let's dive into the charts. So, quick context for anyone who missed it. In late February, a major escalation in the Middle East led to the closure of the Strait of Hormuz. About a fifth of global oil supply flows through that corridor. Shipping was rerouted, energy prices surged, and risk assets sold off. So over the following weeks, we got escalation, selective transit deals, diplomatic back and forth, and eventually a partial reopening effort. And as of this week, the situation is unresolved. But markets have moved on, and that is the story, not the event. So the reaction, because the reaction tells you everything about the underlying regime. So here's the full scorecard, 22 assets ranked from pre-shock close on February 27 through yesterday. And you see crude oil is up 32%, broad commodities up 21.5%. And that is the direct supply shock, and nobody's surprised. But look, what else is green? Bitcoin is up 15.3%. Ethereum is up 22%. And Saudi Arabia, believe it or not, is up 8.6%. Nasdaq is up 5.5%. S&P is slightly up with 2.4%. And also Israel is up 6.4%. So that's something nobody expects in this regime. Even I'm surprised about the strength. High yield, basically flat, not blowing out. That's important. And even EM equities, which drew down 12.5% during last weeks, have clawed all the way back to flat. So count the green bars. Out of 22 assets, 13 are positive in the middle of an active energy crisis. And that is not a fragile market. That is breadth. Now, the losers. Gold miners down heavily, down 15.7%. Gold down. It's 9% down. Treasuries, your lovely hedge, down 4.3. Shipping, who would have thought that? Also down. So we will come back to gold and bonds because that is where the real insight is. But the headline is this: risk assets are working, and the market is telling you something that the headlines are not, and that's not true. So I'm a great fan of Ryan Detrick from Carson Group. He has been all over this. He posted on X the stat that the S&P just locked a 7-day winning streak with 7% plus gains, and that has only happened 10 times since the 1950s. The average 12-month forward return plus 14.2%, and the worst the S&P did 6 months later in the last 3 occurrences, nearly a 90% gain. So Carson also compiled 40 major geopolitical events over the 85 years, and the average S&P return down 0.9% in month 1 and up 3.4% at 6 months. So we are tracking that pattern almost exactly, but faster. So the full drawdown was recovered in under 7 weeks. The S&P 500 is at a new all-time highs. Nasdaq has been up 9 of the last 10 sessions. And yet, look at the sentiment data. Fund manager surveys are cautious. Retail equity allocation is below average. Cash levels are elevated. So the narrative everywhere is this cannot last. The energy shock has not played out. The second order effects are coming. And that is what hated rally looks like. The price goes up while people explain why it should not. And historically, that is one of the most bullish setups here. Markets do not top on disbelief, they top on euphoria, where we are nowhere near euphoria. And then we have the store of value showdown. Yeah, so we go to commodities here. And I think that's the most interesting divergence in the data. 2 assets, both in the store of value bucket, both theoretically built for exactly this kind of environment and completely different outcomes, right? So you have Bitcoin in purple here up 15.3%. Never drew down from pre-shock levels, so the worst dip was minus 0.1%. And gold, here we have it, gold is down 9% through of minus 17%. Gold miners got obliterated, yeah, so they are down 31% at the worst. So the correlation between them during this period is 0.26, very low, essentially uncorrelated. Same crisis, same store of value mandate, opposite results. Now, I want to be clear, I'm still a gold bull, but context matters. Gold had an absolutely monster run coming in, up 83% under 12 months before the shock, up 55% in just 6 months. So that is one of the biggest gold rallies in modern history. Positioning was crowded, everyone was long. So when the shock hit and margin calls came in, gold was not a safe haven. Gold was a funding source. You sell what is liquid and what has big unrealized gains. Gold was both. Same playbook as March 2020. Bitcoin did not have that setup. No margin overhang. And structurally, it is a bearer asset with no counterparty risk, no shipping route, no central bank that can freeze it. So when major energy corridors close and sanctions fly, that neutrality has value. So the takeaway is not that Bitcoin replaces gold. The takeaway is that the store of value bucket needs both. The near zero correlation during the most volatile 7 weeks and years proves the diversification case. A portfolio with gold and Bitcoin is better hedged than one with either alone. And one more thing on safe havens, treasuries are down 4.3%. No flight to quality. When the shock is supply side and inflationary, duration becomes a liability, and bonds and equities sold off together. So this is a scenario we wrote about in our 60/40 paper. Under fiscal dominance, traditional hedges fail exactly when you need them. And if you want to hedge a supply shock, you need real assets in crypto, not duration. Now, let's go to the equities, the equity dispersion. the equity map because this is where you see the breadth story most clearly. US equities fully recovered, new highs. The bull market absorbed an 8% drawdown and reversed it in 7 weeks. And that is strength. But it's not just US. Emerging market equities clawed back from minus 12.5% to flat. Europe from minus 12% to minus 2%. Japan from minus 12% to 3%. Even South Korea, which crashed 23%, has recovered to minus 3%. And the V-shaped recovery is not a US-only phenomenon. It is global. The breadth of the snapback is what makes this significant. So if only the US had bounced and everyone else stayed down, you could call it narrow. But when you see emerging markets, Europe, Japan, Korea, all recovering in sync, that is a risk-on regime across the board. The dispersion within the recovery is telling, though. So energy producers led, Saudi Arabia up 8.6%, Israel up 6.4%. So the ES, which is relatively energy independent, did better than the energy importers. Korea and Japan, which are most exposed to Hormuz, had the deepest drawdowns and the slowest recoveries. Energy dependence is the new vulnerability map for global equity allocation. When we go to the full scorecard here, out of the 22 assets, 13 are positive. Equities, commodities, crypto, and credit are all working. The only losers are gold. That is the positioning problem, not a thesis problem. Long duration treasuries, that's the inflation problem, and the shipping index. That is breadth. That is not a market clinging on to one trade or one sector. That is broad-based risk appetite across asset classes, across geographies. So the bull case comes down to this. One, we are in a bull market that has now survived the biggest geopolitical supply shock in decades. Detrick's data shows that this kind of recovery momentum, 7 days, 7% gains, leads to strong forward returns historically. Two, sentiment does not match price action. People are in disbelief. That is fuel, not a headwind. Markets do not top when everyone is scared. They top when everyone is all in. And three, the hedging landscape has shifted. Bonds and gold did not protect you. Crypto and commodities did. So if you're still running a traditional 60-40, this 7-week episode was your wake-up call. And by the way, gold longer term is still working and has to belong into that mix. So is there a risk? Of course. The energy situation is not resolved. Second order effects on inflation are coming, but the market is a discounting mechanism and right now is telling you that the worst is priced in and the path forward is up. So I would not fight that signal. So that is the cross-asset scorecard, 22 assets, one message. This hated rally with real breadth, and the data says it's basically not done. If you found this useful, I mean, we also did a 60-40 paper. With the new 60-40 portfolio, we will link that into the show notes. If you found that useful, hit subscribe. We do this almost every week. And yeah, I hope you liked it. Happy weekend and see you next week. Thank you very much.